couple weeks ago, I explained the new senior tax deduction and the mistakes that could cost you thousands. But today, I want to go deeper because once you understand the rules, the real questions become, how do you actually plan around this deduction so you don't accidentally give it back? Now, for a quick recap, if you remember, tax years 25 through 28, taxpayers age 65 and older may qualify for a $6,000 per person deduction or $12,000 for married couples. And the deduction phases out based on your modified adjusted gross income. And we've been hearing a lot about MAGI this year, but it's very important. So if you haven't watched the first video where I break down eligibility and common mistakes, I'll put a link below. But today we're focusing purely on planning. Now, this deduction rewards planning, not just age. This deduction doesn't care how wealthy you are. It cares how much income shows up on your tax return. Two retirees, same lifestyle, same net worth can have very different results simply based on income structure and timing. So number one, we need to focus on our modified adjusted gross income, not cash flow. Most retirees think in terms of spending money. The IRS thinks in terms of MAGI. The MAGI generally includes the traditional IRAs and 401k withdrawals, taxable Social Security benefits, capital gains, interest, and dividends. But it does not include qualified Roth IRA withdrawals, and it does not include money out of your brokerage account except for the capital gain portion, and it does not include money that's coming out of your money markets. So what does this mean? It means if you don't know which of your income sources increases your MAGI, this deduction is at risk. Number two, income sequencing beats income avoidance. A lot of retirees are taught avoid income at all costs. But with a larger deduction, that mindset could backfire. An example, say you need $85,000 per year. That doesn't mean it has to come $85,000 from a traditional IRA. It could look like $40,000 from your traditional IRA, but $30,000 from your Roth and $15,000 from your taxable savings. Same lifestyle, but lower MAGI, more deduction preserved. And this is income sequencing, and this is part of the secret about how we take advantage of this deduction. Now here's a completely different approach. Sometimes creating income can actually make sense, and here's where things get a little counterintuitive. For the right retiree, this new deduction creates a temporary window where intentionally creating income can make sense. A larger deduction means a larger low tax income band, more room to recognize income strategically. This can make strategy like Roth conversions, accelerating IRA withdrawals that you're going to eventually be forced to take out, and could allow us to smooth income across years more attractive, especially when we model it carefully. Once again, this is not about paying zero tax today. It's about reducing our future tax risk and trying to pay the least amount of tax overall, especially once your RMDs and survivor tax brackets come into play. Number four strategy is planning our capital gains. We need to plan the year, not just the sale. Capital gains are one of the fastest ways to lose this deduction unintentionally. Selling appreciated assets can spike that MAGI and reduce or eliminate the senior deduction. Increase Social Security taxation, trigger Medicare IRMA surcharges, and if you don't know about IRMA, look her up. You don't want to know IRMA. But the smarter question isn't, should I sell this? It's, which year should I sell this? And that's something I really want to take home is, when should we do these? We don't want to let the tax tail wag the dog. If this is the right year to sell an asset, I'm not going to not do it just over a $12,000 deduction. So let's keep all this in perspective. But if we can't control it and it's not going to be a bad idea, the year can really make a difference. Planning strategy number 5 is our charitable giving. We want to do this without blowing up our modified adjusted gross income. If you give to charity and you hold appreciated investments, how you give matters. If you sell first, we create capital gains, and this increases our MAGI. However, it can also reduce our senior deduction, but if we donate appreciated assets directly, we can avoid the capital gains tax, still provide a charitable deduction, and we can keep our MAGI lower. So, very different tax outcome, but the same generosity. And the same thing can be said with our RMDs. If we're in this same situation, exact same scenario, if we're going to give to the charity anyway, what if we take that IRA contribution give it straight to the church or whatever it is you're trying to do. Now that's called a QCD, a qualified charitable distribution. That money went to the charity. They got the benefit from it, but because it was a QCD, it never hits our modified adjusted gross income, and that can be powerful in so many ways, not just as $12,000 deduction, but just in saving taxes in general. Planning strategy number 6 is married couples must court everything. For married couples, the MAGI is measured jointly. That also means we have to file a joint tax return. If we file separate, we're not going to get this deduction, and depending on your tax bracket, that could be several $1,000s we're giving up. So we want to look at this carefully. But one spouse's income decision affects both spouses' deductions. And this is also something we want to think about when it comes to survivor planning matters before it becomes an issue. You see, joint filing is not the finish line, it's just the starting point as we work through this deduction. So in conclusion, this deduction isn't just a tax break, it's a planning test. It rewards retirees who understand MAGI. That's a word you're going to want to know what it means. Who are willing to control their income timing, coordinate their accounts, and think in multi-year strategies. And it penalizes people who react instead of plan, pull income from one bucket only, or assume tax software is going to fix everything. So if this helped you, go ahead and hit the like button, subscribe. There's going to be more stuff just like this. We're always looking for opportunities to help save you money and keep more of what you've earned.